Blockworks is hosting its Digital Asset Summit in October. Over 800 institutions are attending, including FTX, UBS, Morgan Stanley, Coinbase, and the London Stock Exchange. To get a discount, use code GUIDANCE250, all caps GUIDANCE250. I'm very happy to welcome back to Forward Guidance Jared Dillian, author of the Daily Dirtnap. Jared, great to have you again.
Yeah, glad to be here.
What are you seeing on Twitter, and how are you thinking about it?
So just for a little history on Twitter, Twitter, like finance Twitter, FinTwit, okay? Like there's nobody in charge. Okay, nobody's in charge of FinTwit. The inmates are running the asylum. But at various points in history, there's a dominant voice or group of voices. You know what I mean? So if you were on FinTwit from like 2016 to 2019, you probably remember that the dominant voice on Twitter was Ritholtz Wealth Management. So Josh Brown, Michael Batnick, Ben Carlson, like that whole group of guys. And really that was, when the bull market was in full swing and it was all about indexing. And if you remember, we were having these big arguments about indexing back then. Like that was the thing that everybody liked to argue about. Is indexing good? Is indexing bad? Is it going to blow up the world? Right? So that's all people could talk about. The only person who really is still talking about that is Mike Green, but we've moved on. Like nobody cares. Like we moved on. And then from 2019 to 2021, it was crypto. So I would say at the center of that was Anthony Pompliano, like Pomp. Like he was the king of Twitter from 2019 to 2021, plus all the associated characters in crypto. And now they've all been discredited. And now I call it the macro doom crowd, right? So it's, I would say Doomberg is probably at the center of it, but there's a lot of, what's that?
It's in the name. Doomberg.
Yeah, it's in the name. So, but there's a lot of macro doom accounts, and they're dominating the discourse on Twitter. So, and that really started, I would say, around the middle of 2021, when the stock market started to roll over. And for sure, like we had bubble-like conditions in the stock market, which they had been warning about for a while. And after they were proven right, and I was sort of part of that, then they became the dominant voice. So now really when you log into Twitter, it's just doom. It is just doom because nobody's in charge, but those are the dominant voices, and that's all you hear all day long.
Doom sells. Doom is attractive. It for folks I don't know perhaps why.
Doom sells, but doom sells a lot more in this environment, with stocks down 20% from the highs. Now that we're in like a legitimate bear market, like there were doom people in 2017, but they were marginalized. You know what I mean? So like it's state dependent. You know what I mean?
Right. And what's popular is always late. And Jared, you're, a lot of people, they're a fundamental analyst or they're a macro analyst or technicals. You do all of that, of course, but your specialty is sentiment. And it's always late. I remember, if you let's say you have a podcast like me, and I know a fair amount about this. Like let's say you have a podcast and you want to do one gold interview about gold, and it's a bullish gold interview. You're interviewing someone who's extremely bullish on gold. That interview is going to do the best and receive the most amount of views at the absolute top in gold. Literally. It's always late. It's always late. Can you apply that framework, Jared, to what you're seeing now with what regards to what folks are talking about with inflation, what's going on in Europe, the European energy crisis, and also fears, sort of the macro, what you perceive as macro doom in Europe? And let me read a quote from your excellent newsletter, the Daily Dirtnap. You say, everyone is gravitating towards the doom porn, and it's an unsustainable level of doom porn. So what are you seeing? Tell us about how you're seeing the doom porn in Europe. And I also note that the things that a lot of people are extremely fervent about that you sort of object to and disagree with, they have beliefs that you had like a year and a half ago. A year and a half ago, you were an energy bull. So it's not like you are a oil hyper bear. I just want the audience to know that. So yeah, tell us what you're seeing in Europe and energy.
Yeah, so this is going to take a while, so just buckle up. So,
Of course.
I mean, so just the background in Europe is they they don't have gas. Okay, so because Russia cut off the gas, so they don't have gas. So so the price of the existing gas has gone up to like $92 per million BTU or something like that, some unsustainable level. And if people really had to pay that, then they would have to severely ration and basically freeze. Like they would be super cold this winter. And I guess my take on that is whenever you find a situation that is unsustainable, it cannot be sustained by definition. If something is unsustainable, it cannot be sustained. So there's really like, if you're the people in charge in Europe, I mean, they're politicians, so they're incompetent, but they're not grossly incompetent. Like they're faced with this problem, people not being able to heat their homes. Like they will find a solution. The solution may be bad, okay? But I assure you that the solution will crush speculators, right? Because this always happens in every bear market. Once shorts, once speculators, once bears get control of the market, the government changes the rules. This happened in the financial crisis in 2008. Everybody was short banks, and then the SEC came in and said, no more shorting banks, against the rules. And there was this huge squeeze. Everybody got squeezed out, and they just changed the rules. So my guess, I have some ideas. I think Europe is probably going to have to cut a deal with Putin. Okay, maybe they do, maybe they don't. But let's say they do. Like gas prices are going to crash, or they don't cut a deal with Putin and they cap gas prices. Now, capping prices, everybody knows, is against free markets. It's a terrible idea, but doesn't mean they won't do it. And if they cap gas prices, speculators get crushed, right? Or they just bring in a shitload of LNG, which I think is already happening. Like I saw something on Twitter today about like 82 ships full of LNG going to Europe. So, but the point is that when faced with a problem, people always figure it out, right? The problem. And the other thing is that for this is especially true in 2022. Everybody's attitude towards trading is infinity or zero, right? Nobody can ever take profits. It happened with Bitcoin. People bought Bitcoin, they rode it all the way up. Like they were never going to sell. Infinity or zero. They did it with Tesla. Now they're doing it with energy. They're doing it with oil and nat gas, right? Like everyone's like, oil's going to 200. 200 or zero. And they will just never take profits. So that's what's going on.
So people who are betting that the price of oil, the price of natural gas, will continue to explode higher like it did from January to June of this year. Now it's, I believe, WTI crude's at $83. So where do you think this is going?
It doesn't look good for oil. It really doesn't. I mean, and keep in mind, I look at everything from a sentiment standpoint. Yeah. Not looking at fundamentals, not looking at technicals. I'm not looking at the chart. I can tell you that with oil down 30%, everybody is just as bullish as they were at 120. They're absolutely just as bullish. One of the reasons they're just as bullish is because of this phenomenon, which I call the low cost basis fallacy. Okay. And the low cost basis fallacy is when you get in early on a trade, it works, it goes way up, and then you start to get sloppy about your exit point, right? Because you're sitting on all these unrealized gains. So just say, for an example, and I know a guy that did this. There's a guy in my new neighborhood where I'm moving. He did this. He's a surgeon. And he's like, yeah, I bought 10 grand worth of Tesla in 2012. Now it's worth $1 million. We had this conversation like 6 months ago. I'm like, dude, you should take some profits. Jesus Christ. Like, take some profits. You're up $1 million on this trade. He's like, no, it's going higher. And I'm like, so he's like, if it goes down 30%, it's not a big deal. I'm like, if it goes down 30%, you lost $300,000. Like,
exactly.
So people, if their cost basis is very low, they get really sloppy. So when I talk to people in the oil market, they're like, oh, I'm long from negative 37. So, I'm down from 120 to 83. So big deal. It's a 30% drawdown. It's a massive drawdown. You just lost a huge amount of money. So when people's cost bases are very low, they become more willing to take losses, which means oil has a lot more downside.
Yes, Jared, I've been shaking my head, and I actually shaking my head because I agree with you so much. Oh, God, I mean, where do I even start? Let's see. So yeah, I think the ultimate example of the low cost basis is you go to a casino, you get $100 in chips, and you run it up to $10,000, and then you're buying everyone drinks, you're tipping lavishly, and it's like, oh, it's the house's money, but it's not the house's money, it's your money, and you're going in with you still have the mindset of someone who has $100, but you don't. You have $10,000, so you should be a little more risk averse. And yes, I actually not buying the stock Tesla, but I, by sheer luck, I happened to have bought my first put option on Tesla, first put option ever, and it was on Tesla stock in February of 2020, and it was a 30 bagger. So incredibly lucky, obviously no skill whatsoever, but I got super overconfident, and it actually literally expired worthless. So it was quite a journey. So I know all about the yeah, it's been the wounds have healed, Jared. It's been a while. I've learned a few things since then.
There's so many stories like that. Like, I mean, I started working in the business in the dot-com bubble, and I can't tell you how many stories of people I heard who started out with nothing. They became millionaires in dot-com stocks, and then they went back to nothing. All the time. Infinity or zero.
Yes. And with regards to oil, there can be, a fund or someone on Twitter who bought an oil stock that crashed in March and April of 2020 to $1. And because they were lucky or smart or more likely both, they bought a lot of that stock. And now that stock's at $40. And so they have that outlook that you're talking about. And more importantly, let's say it does go from $40 to $20. They're still up $19. They're still up, it's a 20 bagger. But someone who reads their account on Twitter, they're going to be buying at $40, and they should not be thinking that way.
Anyway, long story short, people are still super, super bullish in energy. So, it's like I actually, when I'm on Twitter, I actually blocked an account today called Oil Rambo, and it's like. It was a guy who's just like super long oil, and he just like trolls everybody who doesn't like oil. It's like a troll account. I'm like, it's like Bitcoin in 2019, 20. It like you have this whole pack of people, and it's like $200 or bust. So yeah. It's incredible.
Although, so Jared, for your call to be correct as of right now, September 8th, oil Twitter would have to be like Bitcoin Twitter in 2021, right? Because Bitcoin Twitter in 2020 was extremely bullish, but it turned out to be right. It didn't reach peak bullishness until the absolute top, I think in May, and then later in November. How do you know that you're right and you have a confidence level? Just because everyone's bullish on something doesn't mean that it won't go up, right? The crowd isn't always wrong.
I guess the thing that really gives me conviction on this is that if you talk to anybody in the energy world, right, not naming names, if you talk to the energy bulls, they've taken a 30% drawdown, and there's no introspection. Like, there's no, ooh, ow, like I just took a big drawdown. Shit, maybe I should, close out this position and regroup or whatever. No, they're still like, they're unapologetic. Like, they're still is insanely bullish as they were before. Now, what they believe is happening is like this they're taking a drawdown. This is a correction, whether it's technical or sentiment or whatever. I don't think most people know really why this is happening, and it'll go on to make new highs later. Okay, well, it's kind of the same argument with Bitcoin. I mean, there's a lot of people who rode Bitcoin all the way down. It's stuck at 18,000. And they're just going to hold it for 5 or 10 years. But it's going to take a lot longer than people think to reclaim those highs. It's not going to happen this year. It's probably not going to happen next year. It's going to take several years. So,
and then how are you thinking about natural gas? Because, the price of oil, you can drill oil and you can ship it anywhere, and it's relatively cheap to ship. But with natural gas, it's very hard to transport because it has to be liquefied. And so, for example, I pulled up the stats. The price of a Henry Hub U.S. gas is like just shy of just $8, but in Europe it's $60. So you can make let's see, $52 by shipping it from Louisiana to the Netherlands. So if you're a company, I'm speaking more about the fundamentals now, straying away from the sentiment. But if you're you're producing natural gas at $2 and you're selling it at $8, and the people who are buying it from you are selling it to people in Europe for $50 or $60, that is a pretty good business model. And it could be such a good business model that just because a lot of people are bullish doesn't mean that it's not going to be printing money.
Yeah, I totally appreciate that argument. I think in natural gas, it was last week we reached peak sentiment when the German electricity prices went totally parabolic. They just went vertical, and I think that's when we reached peak sentiment on natural gas. If you look at the charts of the natural gas producers in the U.S., like you had a top and then another top, and now it's coming off. It's a little bit of a double top, and it's coming off, and it's I mean, if you can arb natural gas to the tune of $60, like those charts shouldn't be acting like that. You know what I mean? Like they're actually pretty heavy.
Jared, in your newsletter, you wrote that you've been reading a lot about price caps on natural gas. What does that? How does a price cap work? What are the mechanisms, by which it actually happens? And then, what are the consequences of it?
Well, Europe can just say, it's illegal for natural gas to trade above a certain price, and with a criminal penalty. Like it's just like you can't trade natural gas above a certain price. So, price caps are like, in capitalism, are like the worst thing in the world. They're absolutely the worst thing in the world. And the reason is because if you don't allow prices to rise, prices are a signal. They encourage producers to produce more, and they also encourage consumers to economize and ration. So if you cap the price, then those price signals aren't working, and you'll continue to have shortages. But the reason why I brought that up in the newsletter is because like people are sort of blind to the fact that this is a real possibility. And if you're long nat gas in Europe and they cap the price, like you're going to get carried out. Like that will absolutely happen.
Yes. And in capitalism, free markets, it is kind of hard for there to actually be a true shortage. Like up until this point, yes, there's a lack of gas in Europe that's flowing from Russia, obviously, but actually tankers or storage facilities of natural gas are actually right now higher than their 5-year average. Why? Because governments, companies have been buying tons of natural gas from elsewhere. That's why the price is so high. So there isn't actually a shortage. It's just there's a shortage at levels at prices that we would like. It's just there's not a shortage at 200 euros for Dutch gas. But you're saying if price caps are implemented, then producers would not produce more and consumers would not consume less. So there actually could be a physical shortage of like, there's the natural gas isn't in the tank. It's not where it's supposed to be. Like right now, the natural gas is in the tank. It just costs 10 times higher than it should.
Yeah. Actually, I saw an interesting tweet today from Matt Ridley. I don't know if you know who Matt Ridley is, but he's written several books. One of them's The Rational Optimist. He's in the House of Lords in England. And, what's interesting, he said, look, like, Northern England has like a quadrillion cubic feet of natural gas under the ground. Like, it's there. Like, if you wanted to frack for this in Northern England, like the problem would be solved overnight. You know what I mean? I mean, obviously you couldn't do it overnight. It would take some
time.
Well,
not overnight. Yeah.
But yeah.
And, I would say it's not overnight because it's in the physical world. Like, the Fed could buy $1 trillion worth of mortgage-backed securities in a day if it wanted to. Like it wouldn't, but it technically could. But if you have just a patch of brown or green land, it does take a few months, in some cases years. I mean, the more you're a commodity bull, the longer people say it takes to create a mine or a drilling rig. If you're like super bullish in copper, you're like it takes 50 years to make a mine.
The other thing, I mean, you just mentioned being a commodity bull, like. So I've seen this phenomenon a couple times, and like we have a lot of commodity bulls now, and we had a lot of commodity bulls in the 2000s. And the philosophy behind both of these bull markets is predicated on the idea of scarcity or shortages, right? Like we don't have enough commodities. But if you think about it, like if that's your belief, then you're essentially short human ingenuity. Like what you believe is that humans are not smart, that we won't be able to grow corn, grow wheat, mine for gold, drill for oil, and we won't be able to relieve these scarcity issues. So it's, I find being a commodity bull like a very, very pessimistic point of view. And if in the oil trade, by the way, has turned into the doomsday trade because it's essentially -1 correlated with the S&P. So if oil is up, the rest of the market is down. If oil is down, the rest of the market is up. And if you're betting on oil, you're betting on everything else to go to shit. It's the doomsday trade, and people love that stuff.
Right. I want to revisit a time when you actually were very bullish on oil and oil producers. And not only did you make a lot of money doing it, but you wrote about it in your newsletter, and I read your newsletter, and I actually bought some calls on some oil producers like in January of 2021. What were the conditions then that made you bullish, and how are they different now? In other words, if being a commodity bull is being short human ingenuity, why were you short human ingenuity in January 2021 by being bullish on oil?
Well, that situation was kind of peculiar. We had negative oil. Now, I got long before it went negative. Okay, I'm not saying I picked the bottom. And anybody who says they picked the bottom is a huge asshole because it went negative for 2 minutes. So that's garbage. So I got long XLE. I want to say when oil was trading around 23, maybe 2 months before the crash. So I was a little bit early, and I did take a drawdown. But I'm it was just kind of common sense. Oil at $23, you just kind of you want to load up the boat. They were just giving it away, and eventually they did give it away.
Yeah, true.
They paid you to take it.
Yeah.
So that's it was an extreme. So I just that's kind of how I invest. I would love another opportunity like that, And when oil got up to 120, I bought puts on XLE. I did it too freaking small. I made some money on it, but I should have done that a lot bigger. So,
would you say that energy stocks XLE is the sector of stocks that you're the most bearish on right now?
Absolutely, 100%. Yeah. You don't find these levels of sentiment in other sectors. You don't have a Twitter account called Utility Rambo. You know what I mean?
Yeah, true.
It just doesn't exist. For a while we were calling oil oil coin. That was a joke for a while, but it's absolutely true. And here's a thing. A lot of these energy bulls have shown no contrition at all with this drawdown, no level of introspection at all. They have not publicly said, one thing you could say is, look, my view is temporarily out of favor. I remain bullish. This is a drawdown, but there's no apologies. People are just pretending this isn't happening. And they're leading really a bunch of retail investors off the cliff, so.
Right. So I'm just taking a look at prices. So, okay. So right now, the U.S. oil ETF, which owns a basket of WTI oil futures. I actually think it used to own only the front month, but the government told them they had to change it because of when oil went negative in April of 2020. So that's down 25%. XLE, which is the ETF basket of companies that drill and produce oil and natural gas, that is down 14% from June, and it had a drawdown of 24% into July. So it's a 14% drawdown on the actual. And I believe on the spot commodity, I believe it's worse. 120 to 83, that's worse. But so to have been down that much, you have to have actually owned the front month contracts. But a lot of, let's say I'm on Twitter, my Twitter handle is, oil Super Bowl. That's my Twitter handle. And, I bought at the absolute top XLE. Like I'm only down 14%, that's not, it's not diluted to not have contrition at 14%, especially in a asset class that's that volatile.
That's fair. That's fair. But like you said, it was down 24 at one point, and it actually went down in like a straight line. You know what I mean?
Yeah.
So, but that's a fair point. That's a fair point.
Tell me more about Europe. When you say there's so much, doom obsession in Europe, a lot of it is about energy, but what else is it about?
It's like there was some guy, he had this Twitter threads. There was going to be like a sovereign debt crisis, a banking crisis, a financial crisis. You want to stock up on food and wood and like there was like people are like calling for like mass starvation. Like this is insane. It's absolutely insane. I had when I was in New York a couple of weeks ago, I had dinner with a German friend of mine. He was actually an exchange student at my high school, and I hadn't seen him in 31 years, and we had dinner together.
Wow.
He's a very smart guy. He was a McKinsey consultant, and now he's a consultant at Accenture. And we talked about this European energy issue, and he basically said, Germans are ready for it. They're ready for a cold winter, and they'll tough it out. Like they're mentally prepared for it. So, the other thing you have to remember is that the distance from Germany to Ukraine is about the distance from Myrtle Beach to New York. Like it's very close. So the Germans don't want Putin in their backyard. And
right.
Like there is some talk, amongst these energy guys, like these insane sanctions on Russia and, German people like, want to stop the like I kind of get the opposite impression. Like I think that they're on Ukraine's side and they're going to willing to tough this out.
So I agree with you. I'm more sympathetic to your argument about economic financial doom, about so in other words, financial stress within the European economic financial system of the euro is going to collapse, or sovereign euro spreads in Italy and Greece, they're going to widen out to 70 basis points. I think that, as you said, regulatory institutions, the European Central Bank, as they did in 2011, they will fix that. They can narrow those spreads with their balance sheet. They can narrow the spread between Italian yields and German Bund yields with their balance sheet, as they are doing. They are letting German Bunds roll off, and they are buying net Italian debt, and the yields are, so far it's working kind of. And there really is no limit to doing that in the same way that what the Fed did in March of 2020 and April 2020, because it's just balance sheet. It's all made up, right? It's not in the physical world, I should say. I was at a talk with Zoltan Pozar recently, and he made this point that spreads can be solved with balance sheet, central banks, sometimes governments, but you can't, ECB can spend as much money as it wants. It can't like produce, a barrel of oil from nothing like it can a bank reserve. What do you think about that?
Yeah, I mean, I've heard that argument a bunch of times. You can't print oil,
Yeah.
It doesn't mean that that Europe is in checkmate. And 2011 is a good example because, I was still doing the newsletter back then. I was on like year 3. And like this was, Twitter was still pretty new, but there was still like this macro doom that was going around that Europe is going bankrupt and the euro is going to split apart. We're going to go back to escudos and punts and, drachmas and, just the euro was going to disappear. Never happened. You know what I mean? Like they changed the rules. Like that's always what happens in times of stress. They change the rules. It's so like this is more difficult, but there are solutions. You know what I mean? So, the nightmare scenario is not going to happen.
How do you, so let's say in 6 months, roughly where do you think the price of oil is going to be? You can give me a range. It can be a huge range.
Well, the huge range is 60 to 80. That's my huge range. Yeah.
Okay. So yeah, you're not calling for like $50, $40 oil.
No,
yeah. 60 to 80. Okay. So let's say the price of oil is $65 in December. The I love oil at I love oil on Twitter accounts. What do you think they're going to be saying, and how will you be reacting to it?
They are indefatigable. I mean, look, like at some point you admit defeat, you curl up into a ball and you die. You know, that's what happened to the Bitcoin folks. You know what I mean? Like they're all the have fun staying poor and all that stuff, like it just went away. So that'll happen at some point.
And I remember you battled those people, Jared,
I
on
know.
Twitter, and you was very unpopular.
But here's the thing, right? I'm not saying I'm right all the time. Like I'm not like an egomaniac or anything. But what I often find myself in the position where I'm battling against a prevailing narrative, you know. And it's a very lonely position to be in. And the reason I'm in those positions is because I'm a sentiment trader and I observe sentiment and I observe when sentiment gets too crowded. So basically I'm always in a position where I'm pushing back against the crowd. And that is a suboptimal strategy. If I were to write a newsletter and if I really wanted to make a lot of money, what I would do is I would be a mirror of the mood of the markets. I would be a mood mirror, right? So, you know, Bitcoin is at 18,000. I would say Bitcoin sucks. It's going lower, whatever. And I'm just reflecting the mood back onto me. And that makes me sound smart because I'm saying something that's happening here and now, which is not
people
really
will
different.
like your tweets. They'll subscribe to your newsletter. You'll just get people will love you. Unlike now, Jared, when they hate you.
Oh my God. Yeah. You just need to step away from the keyboard. It's really going to be okay. And I don't know if you had housing, you want to talk about housing today, but this is another example of it. Like everybody is like massively bearish on housing. You know, there's a lot of housing threads and stuff going around, a lot of housing doom porn. You know, it's funny because I'm actually talking to a couple of real estate agents. We're selling our house in about a year, and they show up at my house and they're like, we've been reading a lot of stuff about the housing market lately. What do you think? You know, and like everybody's predicting like another financial crisis. It's not going to happen.
Yeah.
Like people have so much equity in their homes. Like 40% of homes in the US are owned free and clear. There's no leverage in the system. Underwriting standards are great. You cannot have a financial crisis without leverage in the system. You know what I mean? Prices can come down. You can have bear markets in assets where there's no leverage, but it's going to be a correction and that's it.
Yeah. Just because we're not in a housing bull market anymore does not mean we're having a 2007, 2008 style collapse.
A lot of that is recency bias. You know, people just say, "What?" I mean, we just experienced this 14 years ago, so it's fresh in people's minds. So people think it's going to happen again. You know, absolutely not.
Yes, and lending standards are higher, so when people buy a house, they put more money down, and their credit quality is higher. So they don't have a incentive. They have incentives to stay in the home, unlike in 2007 and 2008 when people literally wouldn't even move into their house because by the time they had bought it, they had already defaulted on it essentially.
Yep.
Jared, what do you think about stocks generally?
I think we're kind of in a range, which isn't a very exciting thing to say, but I think the Fed has dictated the terms. You know, we got the Fed put around 3,600 in the S&P. That's when Bostic said we might have a pause, and the market rallied 700 points, and then you got the Fed call at 4,300 where the Fed decided this is kind of stupid that stocks are rallying while we're hiking rates, so they cranked it down further. So I think that's kind of where we are. I think we're between 3,600 and 4,300, and it's going to stay that way until the Fed actually does pause. And the only thing that worries me is that, I really am not. They seem pretty willing to keep hiking rates for a while. Yeah. You know what I mean?
Yes.
Like at first we were thinking 3.5 to 4. Now we're kind of thinking 4 to 4.5. What's next? 4.5 to 5. Like how far does this go? Like it's.
Yeah. So I think the highest price into the Fed funds futures is like 3.9, but it's going to be out there for a long time. And but it is still pricing 50 basis points of cuts, so like an inverted curve. But yeah, I just think I think inflation has to get pretty damn close down to 2% in order for the Federal Reserve to cut rates. Like, yes, they might only go to 4%, but they're gonna stay there until inflation is like 2.5%, maybe 3%. I don't know. And yeah, so maybe people think I'm a fool because I take the Federal Reserve at its own word, which definitely would not have been a good trading strategy of the past decade after the Great Financial Crisis. But because the dot plot was always indicating they would hike rates, but they never did. But yeah, so sort of setting the Federal Reserve aside, like so you're not bullish or bearish?
No,
Don't really have a view.
not really. I mean, I do want to talk about the Fed a little bit. I mean, we mentioned this earlier. I mean, you have to think about how insane it is that we're in a recession and the Fed is hiking. Like, that's insane, right? Like, usually what's supposed to happen is that you have an expansion and the economy grows and inflation starts to pick up, and then the Fed starts hiking and they continue to hike, and then the economy goes into a recession and then they start cutting. They're actually doing it ass backwards. Like, we're hiking in a recession, and what's going to happen is that we're going to come out of this and we're going to be in an expansion, and then they're going to be cutting rates in an expansion. It's totally backwards.
Jared, if you were chairman of the Federal Reserve, what would your monetary policy be? Sticking first with interest rates, and then I don't know, maybe you can talk about QT.
Well, I mean, if you read my newsletter in 2020, probably at the end of 2020, you had inflation picking up, and I said the Fed should hike rates. I think they should have started hiking back then, and I think they should have been done hiking by the end of 2021. Instead, they actually started hiking at the end of 2021. You know what I mean? So that's the mistake, and it's a very obvious mistake. People criticize the Fed all the time. It's very fashionable to criticize the Fed, and I think they just take a lot of abuse that's like not warranted. They are nice people. Like, they're trying their best. Like I firmly believe that they're good people. They're not evil, but the politics around monetary policy just causes things to get all screwed up, so that's the problem.
Yes. And folks who loathe the Fed because they think that they made rich people richer because of QE, and that did not stimulate any growth whatsoever. Those people should be aware that the Federal Reserve now is trying to do the exact opposite. They're not printing money to inflate assets. They are burning money in order to decrease the price level of assets, to have a reverse wealth effect instead of a wealth effect. And for folks who object to my terms of printing money and burning money instead of bank reserves, well, it's just a matter of semantics. Yeah, Jerry, what do you think about the whole burning money thing? Because to me, it's no one who's like aware of the monetary mechanics, which you can, I mean, it does take a while to learn because it can be confusing, but we all know someone who says the Fed prints money, someone who says the Fed doesn't print money. It's possible for both of those people to have a correct understanding of like what actually happens, but they're just using different words. So do you think the Fed prints money?
Absolutely. Yeah. I mean, just Jay Powell went on 60 Minutes and said that he did. You know what I mean? Like, it's not controversial.
Yeah.
So
it's a higher power form of money that you or I can't touch, but it's the asset of commercial banks in the same way that our asset is the liability of commercial banks.
So when people talk about quantitative tightening, the Fed's balance sheet is 8-9 trillion. We're doing $92 billion a month in quantitative tightening. Like, what is that? That's like nothing. Like, it's just a tiny percentage of the Fed's assets, and it has an enormous effect on markets. And that's something like, as an analyst, like, I've never understood. Like, back in 2017, 2018, when we were doing just a tiny amount of quantitative tightening, like, it had a huge effect on stocks. It had a huge effect on everything. So I really find that to be amazing.
Yes, I spoke recently to Andy Constan as well as Joseph Wang, and he made that exact point that it is the flow of the Fed's balance sheet, not the flow of assets onto or out from the Fed's balance sheet, not the absolute size of the Fed's balance. Like you, I'm bewildered as to why that's the case. But yeah, I think that is like, in other words, a $10 trillion balance sheet that is decreasing is bad for liquidity, whereas a $1 trillion balance sheet that is increasing can be good for liquidity. So it's not about the absolute level, but the rate of change. So if quantitative tightening is so bad, and now we're doing almost double what QT was in before when you were referencing, why? How come you're not more bearish?
It's hard to be bearish when sentiment is this bad. You know what I mean? Like this is, you know, this is the thing. This is a position I find myself in all the time. You know, like if you look around, you know, European energy, China, war in Ukraine, right? There's all these reasons for the market to go down. There's really no reason for it to go up. Those are usually the situations where the market goes up. You know what I mean? When there's absolutely no reason for it to go up, that's usually when it goes up, and vice versa. Like, you know, at the top of a bull market. I mean, we were there in January of 2021. There was absolutely no reason for the market to go down. So, you know, this is why, you know, trading sentiment, like people people need, they need evidence. They need evidence, and they're uncomfortable with faith, right? So you just asked me, what are my reasons for being bullish? I'm like, I don't have any fucking reasons. Like, I'm bullish because everybody else is bearish. And then people say, well, that's a stupid reason. I'm like, actually, it's not. Like, it actually, if you back test that over time, like, it works pretty well. But like, people need something to latch on to. And you know, sentiment trading really is about faith. Like, in the face of all the evidence to the contrary, that this stock, this bond, this market is going to go up, like, that's how it works.
Yes. I think that it depends on how you gauge it. So I think you were very good at gauging sentiment as well as extracting meaning from it, and in some cases sort of signals from it. I definitely think it's a skill, and just be like, you could, having never even thought about sentiment, you could sort of instinctually, quote, do it, but just because you can do it doesn't mean you can do it well. So I definitely would caution people from, like, you know, making big size trades based on how they feel about how other people feel. Just because people like you do it well doesn't mean that, you know, it could be done poorly. But there are instances when people are hyper bullish on an asset and then it goes up, or hyper bearish on an asset and it goes down. Like, you know, in December of 2020, people were, you know, one could say, if I was trying to take a contrarian sentiment view, I'd say everyone is super bullish. Like, I'm going to short Bitcoin, but that wouldn't have ended out great. So how do you know? How do you make that specific timing? That's my question.
So really, my process is, it's not strictly sentiment. I also do some chart work, right? So the sentiment kind of gets me in the neighborhood. Okay, bullish, bearish, you know, within a couple of weeks, a month, something like that. And that's when I start doing technical analysis to get more scientific about where the actual turning point is. Like, when I bought puts on XLE, I was 1 day early. I missed it by a day. So I can get pretty scientific about it. But, you know, it's not, and sometimes, you know, sentiment actually works to the day, like an Economist cover or something like that. Like, you get an Economist cover and like that top ticks it.
So you're saying it's sentiment and then technicals, and then when both sort of smell bad, that's a really signal to get bearish. So, for example, to answer my own question, in December of 2020, the sentiment was bullish, so that might have been, you know, a contrarian sentiment signal to not be bullish, but the chart looked amazing because it was exploding higher day after day. You're saying now in energy, sentiment is way too bullish and the chart looks bad.
Yeah, I mean, I do want to add a caveat. So, you know, oil is kind of bouncing along trendline support. Actually, as we're, you know, recording this today, it's actually bouncing a little bit today. Like, it could bounce off of trendline support, you know, but it's not going to get back up to 120 with this many people bullish. So
yeah, and so there's sentiment, which you're an expert in. I'd say that, like, a world expert on sentiment. And then you look at technicals. Those are sort of the two things that you look on. You look at fundamentals and macro, but like less so. I would say on a fundamental case, it seems to me that at least for natural gas, like the case is kind of bullish. If it's $8 over here and it's $50 over here, you know, I wouldn't short the $8 one, you know, and I wouldn't short companies that are making it at, you know, at $2.
One thing I'll say about fundamentals, like I'm not saying that my way is the right way and everybody should do it my way, because some people are very successful with fundamentals. With me, when I try to use fundamentals, I find that I am very, very late to a trade. I am very late. And some people are good at using fundamentals and being early. And I am not that person. You know, every time I just, for example, what was the one like? It was like, I was long Novo Nordisk, you know, with the weight loss drug, Wegovy, right? So, you know, it was funny because I had a conversation with my doctor and we were talking about this drug, and then I did some research on it, and I'm like, I'm a fucking genius. Like, I figured it out. Like, this drug is going to change the world. And I bought the highs. I literally bought the highs in the stock. I was like the last person to find out. You know what I mean? And I did all the fundamental work.
Yeah.
Like I bought it for fundamental reasons. I was just the last person. So it just doesn't work for me.
Jerry, you're exactly right. And I think that's true regardless of who is analyzing it, is that the fundamentals always, in some ways, look best at the top. Like natural gas companies, the fundamentals have literally never looked better than right now. And obviously, it was, by definition, it was a better time to buy it in May of 2020 when the fundamentals looked absolutely horrible. So you have to foresee the fundamentals and predict them and accurately predict how those forward fundamentals will be priced, as opposed to just saying, oh, wow, like this company is trading at a 10 PE. It's a buy.
Yeah, that's how you get yourself in trouble.
Jared, how else do people get themselves in trouble? And maybe in this current environment, other than being super hyper bullish on oil, natural gas, energy, what do you think people are doing or saying that is getting them in trouble that you think will not be good for them, that you're trying to avoid?
I think that what a lot of people do is they make assumptions that the current market environment is going to persist forever, right? So this environment we're in right now, energy is outperforming, tech is underperforming, interest rates are going up, gold is going down, all this shit. So this regime, people think that this regime is going to persist for a long time and these trades will continue to work. But what happened inevitably in the markets, like regimes change and different things start to work. You know, one of the things I like to say about the markets is that they exhibit a property that I call non-stationarity. And non-stationarity means that you're playing a game where the rules constantly change. You know what I mean? So, like, it's a bit like playing chess. You're playing chess, and the knight goes 2 steps forward, 1 step to the side, and then you change the rules, and it goes diagonally. And you just have to completely alter the way you play. And a lot of people get caught up in regime change, and they just aren't able to adapt. And how they were making money before, they can't make money anymore. You know, so I guess what I'm saying is this regime that we're in, which has lasted about 6 or 8 months, like it's not permanent. It's going to change. I don't know what the new regime is going to be like, but everyone's going to get sconed.
Another bugaboo of you, Jared, is the dollar, which has been extremely strong against the yen and the euro in particular. What are you seeing in terms of how the sentiment is towards the dollar, and how does it inform your view on the dollar?
Well, I made a pretty noisy short call on the dollar, and I got stopped out, but not by much, by like 1%. But you know, like if you have integrity on Twitter, then you say that you were wrong. You know what I mean? So it broke through my level, and I stopped myself out. Whatever. I'm still bearish on the dollar. I actually think we're making another top as we speak. You know, even in the last day or two trading days, the dollar has sold off quite a bit. So I don't what the catalyst for that is. I'm not really sure. You know, maybe it's Europe getting better. Maybe it's the Fed pivoting. Who knows? But the chart looks pretty toppy for me in the DXY. So
yeah. So, obviously you're an expert in sentiment, so that's what you're paying attention to, and things that drive currencies. There's a lot of like flows and inflation, and I'm sure people who are listening to that know a lot more about that than I do. But I do pay a lot of attention to central banks, and for a while, the Federal Reserve was early to the race. It got a jump start in hiking interest rates, and then it also did forward guidance. So interest rate, like the 2-year, moved up even more. And the ECB, the BOJ, and the Bank of England were kind of behind the curve by design. That's changed. Like, we're recording this on September 8th, and I watched Christine Lagarde's face, and she's just telling journalists, no, like we're serious this time, and yeah, we're hiking by 75 basis points. We're hiking more until inflation's under control. And then the journalist is like, but has the bond market priced in your hawkishness too much? And she's like, are you dumb? Did you listen to what I just said? So I interest rate differentials matter a huge amount for currencies. And if a big driver of the euro's weakness against the dollar was that euro yielded 0 and the 2-year US Treasury yielded 2.5%, now like 3.4%, and so money just flooded into the US, I think that on net could change a little bit. So net, like I think that the euro. I mean, I don't really have a view, but I think I think the euro has a better chance against the dollar today than it did like 2 months ago.
Yeah. I mean, the one thing I will say is, like, people forget this. Like, if the let's say the Fed pivots, right? The dollar is going to move like a week or two before it pivots, right?
Lower?
Oh yeah, lower. Yeah. Like, that's how markets work. You know what I mean? So you hear people make these statements like, oh, like, the dollar will you can get short the dollar when the Fed pivots. Yeah, by the time the Fed pivots, it's too late. It's too late, which is why you need to trade sentiment and why you need to trade the charts, And actually, it's funny because, Brent Johnson, who I think is a friend of mine, but I when I was at Bloomberg over the summer, I wrote an article about the cult of the dollar bulls, right? And I mentioned Brent Johnson. Now, I wasn't pejorative, I wasn't ripping on him, but basically I said, like, he has a lot of followers. There's a lot of dollar bulls out there, and he's kind of in the middle of it. And I think that's a top in the dollar. Well, it was kind of like an interim top, and then we recently blasted through that. But I mean, sentiment in the dollar is it's, I wouldn't say it's as bullish as energy, but it's very, very bullish.
Yeah. Well, dollar bulls make me think about bond bulls who, it's been a tough time because duration has felt so much heat, and it's just really been a very vicious trade for long-term bonds, particularly like the 30-year Treasury, TLT, drawdowns that you just are not supposed to see in a long-term Treasury bond, like that we haven't seen since the 1970s. How are you thinking about let's say TLT? Because in that space, I do see a lot of people where like TLT goes from 160 to 150 and they're like, I'm still bullish. It goes from 150 to 140, they're like, I'm still bullish. It goes from 140 to 130, I'm still bullish. 130 to 120, still bullish. 120 to 110, I'm the most bullish I've ever been, like, so I don't know. And obviously like a 3.5% 30-year Treasury, to me, it sounds like good value because for my, entire adult life, it's been way below that. But I don't know. What do you think about the duration?
10's got up to 3.5 the first time on that CPI print where everybody panicked. And then it rallied all the way to 2.5. Like, I don't know if you remember that, but it got all the way to 2.5. And now it looks like we're going to do a double top at 3.5. 2.5 on 10s is too low. Like, that's pricing in a large recession, which I don't think we're going to get. So,
and a large fall in inflation, which we're also not going to get.
So 2.5 on 10s was a good selling opportunity. Honestly, I think we should kind of be in a range between like 3 and 3.5. Like that kind of makes the most sense. I don't really see a scenario where rates go to 4, 4.5, or some absurd number like that. It would cause, I mean, it already is causing a lot of pain. Mortgage rates, as of today, the mortgage rates came out. 30-year fixed mortgage in the U.S. is now 5.86%. It got up to 6.2% a couple of months ago, but 5.86% is, pretty high in the context of the housing market not doing so great. So the one thing I've always been a little puzzled about with the Fed
Yeah.
is that the Fed has historically protected the housing market a lot more than it is right now. I mean, the housing market is our number one engine of economic growth. And they seem to be like sort of willfully oblivious to the fact that the housing market is like gagging, because of all these rate hikes. And they don't really seem to care, So it's kind of interesting to me.
I just want to square what you said with your earlier comment that we're not going to have a 2007, 2008 real estate collapse.
No, we're
interest
not.
rates, mortgage rates have shot up. So the housing market, it stopped going up. And in some instances, it's gone down. In the case Schiller, it's really hard for that index to go down just because it's like diversified, which is funny because it's diversified bro argument was like what caused the 2008 financial crisis. But I think the Fed, they're like the homeowners, they're fine. Inflation is I think the Fed has one and only concern, and that's inflation. And that obviously could change, but right now that's what I think. Do you think that
it might change after the midterms?
Yeah, tell me about that.
Well, I mean, Biden's approval rating is 38%. Probably the biggest driver of that is inflation. So the thinking is we're going to fight inflation hard until the midterms and then ease up on it afterwards. Maybe that's a cynical way to look at it, but could happen.
Yeah, you could be right. Well, Jared, I want to ask you, so it sounds like in the short term, you think CPI will fall, inflation will fall quite sharply because if you're right about the energy, so much of the headline CPI has been these energy prices. But what about longer term structural inflation? I was reading in your newsletter, the Daily Dirtnap, that you think 2% is, it's not 2% inflation as being the norm is not going to be the norm anymore. So what is the new norm? 3%, 3.5%? And does that change the macro environment for like the next 5 years?
I would say 4 to 5. I would say 4 to 5 is as low as we're going to get. We probably get there in middle of 2023. Basically what that means is we're not going to have zero rates again. That's not happening. We're going to have persistently high interest rates. Now, when a lot of people hear that, they're like, oh my God, stocks are going to crash, blah, blah, blah. No, not necessarily. I mean, I was, when I came into the markets in 1999, Fed funds was 6.5%. And I want to say inflation was like 4.5%. You know what I mean? So, which is like, and the economy was doing great. So it's, I think we'll do fine under those circumstances, but we're not going to have this ultra loose, ultra easy.
Jared, sorry, the stock market, you joined in 99. The stock market did not have a good time your first few years of your career.
Well, eventually.
It did for the first year, but after that, like
they hiked so much that it gagged, basically.
Yeah. Right.
So.
Yeah, that was my reaction, to be honest, when you said 5%. So you think the lowest we get is 5%, and then that's 5% is the new 2%? That seems, that means that, inflation expectations have to be higher than they are now. That is, to me, it sounds like a pretty bearish scenario for stocks as well as bonds.
It's not bullish.
Yeah. So when you say you're bullish on stocks, that is a more shorter term trading thing rather than a 5-year time horizon, which is what we're talking about now, right?
Yeah, I heard Rosenberg is saying we're going to get down to 2,400 in the S&P. That's not happening. It's definitely not happening. So,
I have a lot of respect for David Rosenberg. I think that if we do get down to the 2,400 in the S&P 500, it is because of inflation, and I'm pretty sure Rosenberg's case is it's because of a giant recession. So, yeah, interesting. Well, Jared, you've been really generous with your time. Before we go, I want to let people know that. So I had read your first book, Street Freak, which is autobiographical, very good. It's very popular. People probably already heard it already. I didn't know about your second book, All the Evil of This World, which is actually a novel. Which you don't have a lot of folks in finance writing novels. And Jared, because you're in finance, I always forget how good of a writer you are. You know what I mean? Because like people in finance are not good at writing, but you're a really good writer, and it's a tale of a specific trade in I believe 2000 in the options pits, but it's told from 7 different characters, and it's not just about finance. There's a lot of it covers, like many other novels. It's about the human condition, not the trade, not a particular trade. So yeah, I love the book, Jared. So thanks for recommending that.
Thanks. That is my favorite book. I really really like that book, and I think everyone should get a copy. What I told you was if you read the first page, it's going to punch you right in the face, and then you're not going to be able to put it down. So
yeah, it really did. I really was probably more surprised by the first page of this book than pretty much any other book I've ever read. It's a truly stunning first page. That's all I'll say. And Jared, the second thing is, in addition to being a investor, trader, real estate, newsletter writer, and author, you are also a DJ, as well as Bloomberg intern. You're also a DJ. You have a concert coming up in New York. Tell us about that.
Yeah, so we got a party coming up September 16th, Friday, September 16th. It's at DOUX Supper Club in New York City. It's at 59 West 21st Street. If you want to buy tickets, just go to my Twitter page and just kind of scroll through. You'll find a link there somewhere. You can also just show up at the door. You can buy tickets at the door. Would love to have a bunch of people there. It's my party. I mean, Jack's been to one of my parties. It was a hoot. So, and the music is going to be amazing.
Really great music. I was there. Yeah, people should definitely show up. I'm going to be there. Jared, people could follow you on Twitter, of course, at Daily Dirtnap. Thank you so much.
Thanks, man.
There is something that you need to be doing right now, and that is reading the Blockworks Daily newsletter. For top market insights and the latest in crypto news, you have to subscribe to the Blockworks Daily newsletter, and you can do so by clicking on the link in the description to this video or by visiting blockworks.co/newsletter.